6 is compressed.
So since we have a lower, we're now saying we have a low real risk-free rate of return, in fact, a negative one, then our nominal arithmetic return should still be going down relative to where we were a few years ago, which is still true, right?
That's correct.
Yeah. And I guess the question that I have is I hear what you're saying about, you know, the impact on equity prices of a negative real risk-free rate of return, but I also notice that, you know, companies don't know what to do with cash, which is why they're sitting on billions and billions of dollars of cash. Some of that is held offshore, presumably for tax reasons. But I wonder whether if we're expecting a 10-year, if we're looking at 10-year assumptions, and over a 10-year period of time, we're making an assumption that fixed income returns are going to be poor, 5% relative to, or 3% compared to 5%. That seems to presume that we think that rates are going to go up, or certainly not go down anymore. And if they go up, then doesn't that undo that arbitrage in the equity markets, and therefore undo the reason to think that real returns in the equity markets should be higher than in the past?
Okay. Well, first, let me introduce John Linder. I'm not going to ask him to talk yet. He's spent, if you read our report, we go into some great detail in how we develop these assumptions, particularly the equity assumption. But the big risk, to answer your direct question about inflation, modest inflation has historically been good for stocks. It's inflationary spikes and unexpected inflation that's really, really bad for stocks. And so if we get modest inflation, which is relatively under, in quote, under control, historically that's been very good for stock returns because they can pass those on to consumers in pricing. It's rapid inflation that destroys stock value.
And the research on that, which shows positive equity returns in a benign real inflationary environment, usually uses a threshold of around 3 to 4% of inflation each year. We're not even close to that.
Right, but I think both your estimate of high equity returns and your estimate of poor fixed income returns is actually not based on inflation per se. It's based on very low real rates of it's negative inflation adjusted real rates of return. So because of low negative real interest rates. And so what I'm saying is it seems to me that we're applying an assumption inconsistently. We're applying it in one direction, one way to equities, and taking the same assumption and applying it with the opposite result to fixed income. And if we don't think that negative real risk-free rates of return are going to stay negative for 10 years because primarily through Fed action that would continue for 10 years, then how can we apply that assumption to come up with high equity returns when we're trying to forecast over a 10-year period?
Yeah,
It's not opposite.
yeah. You bring up a paradox, and I think the resolution of at least in the way that I think about it, or that PCA thinks about it, is that over long periods of time, 10 years, equities tend to be real return assets, whereas bonds, which don't have an adjustable coupon, are nominal return assets. So you can have that disconnect between cash flows that can adjust to inflation vis-a-vis cash flows that do not adjust to inflation.
And in the process, determining the expected return for a bond is very straightforward. You know, you look at the yield to maturity, you make a few adjustments, and that's your return. You know what you're going to get out of a bond, particularly a fixed interest rate payment bond. So it's very, and you can correct me if I'm wrong, John, but that's pretty straightforward to get to the total expected return of a certain type of bond. So in the exercise of determining the expected return for equities, what we're trying to do is figure out in a sense, what the real yield on equities is. So that's not opposite. Those are two different exercises we're going through to come up with expected return for two very different instruments.
Well, maybe let me ask it a different way. Does your expected return on equities, the risk premium of 650, does that rely on there being a negative real risk-free rate of return over the entire 10-year period?
Did you get the question?
Yes.
I think the answer is yes to that.
Um,
Is there going to be a negative real risk-free rate over the entire period? The answer is yes. I mean, on average.
On average.
On average, it's
On
going to be
average.
negative 75 basis points.
Right.
Right, but
So-
keep in mind that it's more than that now, but
Yeah.
it could be much high, you could have a very different scenario in the second 5 years.
In the back end.
And once again, these are averages.
Right.
And just to get directly to your point, this is still a lower expected return for equities than was had previously. And it is in fact, when you use geometric numbers, relatively conservative compared to the peer group.
Okay.
And we just need a number so we can do modeling, so you can make choices. The only thing I can guarantee you is that with possibly the exception of bonds, every one of those numbers in 10 years will be different than what's on that board. There's no evidence that anyone in our business has any ability to forecast the future. This is a tool. And we could spend a lot of time going back and forth on what the right number is, and only history will be the judge of who's right. And I think you're right to challenge us, because that's your job. But the staff and we have given this a lot of thought, and we think these are, in quote, reasonable numbers.
Okay, and I'm comfortable with that. I just think it does seem that that baked into it is kind of a continuing federal policy, Fed policy, that, you know, that if in fact, you know, doesn't persist for the 10 years, could make even these equity assumptions, which are more conservative than they were 3 years ago, over optimistic.
Overly optimistic. And one last point, Madam Chair. You're going to redo this in 3 or 4 years. And we're gonna-
That's the
we're-
beauty behind it.
And then we're going to come back and we're going to have more information, better knowledge. And at that point, we can either laugh at each other or say we were very smart. But this is an ongoing process. It's not something that won't be reviewed for 10 years.
You'll be doing this before you even get to the second half of that time period. You'll be doing it in 2015.
Good. I think we have one last question, and then I think we're ready to.
Just curious and a basic question, but throwing out 2008, if you go back in time and you look at prior forecasts relative to where the numbers have ended up, how close or off are we, in what direction? What's our overall experience?
We would prefer not to throw out 2008. And I know that
All
my,
right, include 2008
my-
if you
I know-
like.
I know my
But
call- I know my-
In my other hat, my general forecasters prefer to throw out 2008.
yeah. There is one, like just Alan just said, there is one boatload of forecast error in the equity numbers. That we're, not only us, but every other consulting firm practitioner, you know, look, if you could do a look back, we all had, I would say, 10 years, 2003, somewhere in there, you know, 10 years ago, 10 plus on the equity return. We got 0, flat, 2, whatever it is. We were way off. On the bond numbers, you know, surprisingly, pretty close, you know, in terms of what bonds have produced up to this point. So the yields on bonds back in that period of time were 5.5 to 6.5, and that's what you end up getting. You end up getting 6 to 8% return out of just the generic bond portfolio up to this point. So they've produced very good numbers for you. So we're very close, but so I mean, if you take that kind of feel, to what's going to happen going forward, we're going to be pretty close with these bond numbers. You know, maybe we'll be 1% off, maybe it'll be 3.5%. You know, if we're totally inaccurate, maybe the bond markets will do well. But we're going to be pretty close on the bond numbers and those equity numbers. You know, hey, maybe we're going to get another 2% per year for the next 10 years, but we maybe end up getting a positive 15. It's going to be that big of a gap. We don't know.
But the one thing we do know is that if you look at the very long-term returns for the system as a whole, they were not that different than the expectation at the beginning of the period, plus or minus 8%. Now, we don't think that's going to happen going forward. But so using the work that was done 15 and 20 years ago, where they said, we think we're going to get a return of plus or minus 8%, which is embedded in the actual interest rate assumption, that was a pretty good number. But that was because it's a diversified portfolio, and one of the assets didn't work, something else worked.
If I could jump in on that, if you look at INV 107, the graph at the top, we talked about this yesterday, PCA doesn't know with the actuaries. That is the U.S. equity market return all the way back to the Civil War, and it emphasizes why we don't want to leave out 2008, why we want to include that, because that distribution tail to the left is fatter. It is not a traditional distribution curve. And part of the challenges, as PCA is bringing up, look at the actual experience, it looks more like a mountain range where you have a couple of averages. And we're expecting stocks, if you look at that 5%, we're expecting stocks to be at the upper end of that. That gives you the feeling of how we're trying to be conservative and lean to what has historically been experienced. And if you flip the page to 108, that shows you the period of 1970 to 2012. So since Bretton Woods, more of a floating currencies and what we consider the more current environment. And the tail's even deeper. So that's why it's important to keep in that volatility.
So I'm just going to direct us, I want to be clear on the direction that we need to take because it's an action item. It's to adopt PCA's 2013 assumptions, capital assumptions for our 2012-13 asset liability study. Is that accurate? So I'd entertain a motion. Is there any discussion? Any more discussion?
So moved.
Second.
All in favor?
Aye.
Any opposed? Abstentions? All right, that's approved. Okay, thank you. I'm going to ask the board for what's your pleasure? Do you want to try and get through 12B and then do lunch? Or do you want to take lunch now? What's the pleasure of the board? That's always the magic question.
Board as opposed to consultants.
Not a lot of presentation, it's really up to you.
Right,
Okay,
let's try to do
let's
it.
try and do 12B now, and
We're gonna bring up, we're
power
gonna
through.
switch.
and then we'll do lunch after 12B.
We're gonna bring up our actuary component, because where would we be without an actuary?
If you got, this is my slides, if you could hand me the flipper. And I would, but as we move on, I just, one note, they left the front quietly. But I just want to again thank John Gray and Peter John Robinson from Gray and Company, who came all the way out here from Atlanta. It's the first time we've had a chance to hire them as a consultant. I thought they did an outstanding job. I believe we're the biggest fund they've worked with. They have a lot of clients around the country, but I just wanted to thank them for coming out here and also gathering that data. They did a great job for us. So now we're going to step into the question of the key decision factors. As we put this agenda item together, I was not able to include the staff recommendation in there because of the timing, so I have it here for you. I apologize for that. I know you like to have stuff in advance. PCA is proposing, and they'll go to their slides, but it's INV. Boy, my stamp went through. 176, and that's what these three are. They're proposing 3 decision factors. So keep in mind, you're going to pick basically a multiple choice list. In June, you're going to vote on it, but you don't have to pick one. It's not going to be multiple choice. What you're going to do is we're going to give each of you 10 points. You get to weight it. You might say, you know what, I'm going to put all 10 points on that return oriented. That's the only goal I care about. I don't even care about the other ones. Or you might say, you know what, I'm going to divide them up and I'm going to weight them differently. As you can see in our book, the board has had a different set of key decision factors in 06 and then again in 09, and they weighted them differently because the boards are different and their experiences were different. So PCA is recommending 3, a return-oriented one and then 2 protection or risk-focused ones. A couple of key points you need to think about as the investment committee. Even if we were able to get contributions right away and at the level we want, the funded status will decline. So some of our statements about improving the funded status, it does not mean it will go straight up from here. If we get contributions and earn 7.5, the funding status will drop until about 2017. So that's the best situation. In the worst situation, if we don't get funding at all, contribution increases. You already know the story. If we don't get anything at all, we run out of money in 2043. The actuary showed that again yesterday. In some of the other scenarios we provided the legislature, some cases we dropped to 55% funding or 52% funding over the next couple of years. So funding will decline even if we earn 7.5. Staff is recommending a list of 4. We think it would be better for you to have an equal number of return-focused and then risk-focused. So we're recommending the 2 that PCA suggested: avoid a significant drawdown within the next 10 years, and then minimize the likelihood of pay-as-you-go, pay-go, beyond 10 years. You can change this wording too, if it's more meaningful for you. You've been through all the funding scenarios and the workshops with Ed and the actuary, so I think you're very well suited to do this. We're recommending 2 on the positive side. One would be pursue a better funding ratio over the long term. That's very similar to what PCA said, just slightly different wording. It implies that we know funding's going to get worse before it can get better. But then the other would be seek to keep the actuary costs, the ARC, fairly steady. Now, you don't control rates, but you know that if that normal cost, remember yesterday the actuary talked about normal cost. If normal cost goes way up, your funded status goes way down. And so this would be where you want to earn enough to keep that fairly steady. So I put them in green because they are return focused. The other 2 are risk focused. You need to pick the wording. You would vote on what's going to be in the future. One thing that did come up in my discussions with board members is you have to kind of decide, not as a committee, but in your heart, do you believe that at some point we will get a contribution increase from the employers? And the reason why that's important is, think of it this way. In our baseball analogy yesterday, Rich, if you assume we'll never ever get a contribution increase, then we're going to run out of money in 2043. So you'd be building a baseball team that you knew was going to shut down in 30 years. You might build that team a bit differently than if you assumed we got some revenue and we stay in business. So it's up to you to decide how you want to think about that. But that's kind of a very profound impact on how you view these risk statements. So, and Neil, do you want this? Sure. Okay. You want to bring up the PCA slides?
Staff sent those.
Those 4 were the CalSTRS staff
Right.
recommendations,
And
and I'll be
where are
able
they?
to bring them back up.
Where are they in our materials?
I apologize, they are not
Okay.
in your
That's
materials.
what I was like, looking
We're
for
not
where they-
able to get them in there in time, so
So they're
that is
just
the
on the
one
slides. Okay. So we
big
might
mess
need to
up
get
on the
those.
year there.
Our presentation going to show? Good.
Okay, well,
They're just
Well-
queuing it up.
well, Neil's
Wondering what to
addressing
do.
that. Let me make a caveat that I've made every single time that I've had the privilege of coming before this board on this presentation. The investment portfolio will not solve the funding challenges that face this system. That's a fact. It can change the dynamic of when things go down or how much they go down. Or in fact, with certain solutions, it could dramatically make things worse. And it's important to keep that in mind. And that's why you have green lights and red lights in terms of these decision factors, because you, as policymakers, need to balance. Just like you do when you're driving the car, you might be in a rush to get somewhere, but if you hit the gas too hard, you spin out and you get in an accident. In this case, the potential exists with another 2008, 2009, that for all intents and purposes, you're no longer a going concern. And I urge you, as part of your thinking, as you go through this process, to keep that in mind.
Okay, it looks like we may not have the PowerPoint for some reason. But you all folks, you have your hard copy booklets, right? So if you go to page INV 181, Chris stole a lot of the thunder out of my presentation, so I might as well just race to some of the other salient points. So if we go to INV 181, this is, given what Chris just said about you, and I think some of you understand that you're going to be picking from these concerns that we want to get from you, and you understand that idea. So this is what you did back in 2009 here on INV 181. And you know, the first thing to do is just look at the balance between what Chris sort of identified were these, you know, return-oriented factors, the green and the red. And I think we're going to end up having a little bit of debate here. I'm not an actuary, Bob is. But when reading the reports that have come out, the valuation reports and the sustainability report that your staff wrote that you sent to the legislature's response, you have no control over the costs. So should that be a goal? And I would say at this point in the game, I don't think the costs are going to be a given to you. You have other concerns that you have to manage, not so much what the ARC's going to be. Now, I think there might be some differences of opinion on that. So I'm almost thinking, in coming up with the three that we came up with, that we're really not looking at employer cost issues anymore, because the state's just going to tell you what they're going to give you, and that's about it. You know, they're either going to it's either the status quo, or maybe they go for option one that you teed up to the state, and hopefully they figure out a way to give you an extra $5 billion a year. If not, it'll be somewhere in between that, and that's about it for the next, you know, several periods. They're not going to come back and adjust that for you if the portfolio goes down. Alan says, you know, it's probably, you're going to be figuring out how to be in business. So that led to these things that Chris highlighted, which are back on INV 178. And again, as Chris said, we're just putting these out to figure out how you're going to respond to these. There might be other concerns that you have that are not even on this page. But as we review the system-wide issues, we see that, you know, one goal is going to be to, as Chris showed, that the funding improvement is to try to stay as close to that line as possible based on what the planners and the policymakers are going to do. That's the first one. That's a return-oriented one. That's getting that funding to go along that path and improve over time. And then the other two are really event risk, you know, during the horizon risk management issues. One is we don't want to have a, you know, is it a concern of yours not to have a drawdown in the portfolio, yes or no? I mean, we're putting it on there saying probably if you do in the next, you know, 10 years, if we get another 2008 or somewhere close to it, a -15 to -25, it's going to be a big deal without supporting contributions. And then the longer term question is, you know, can we manage the system, you know, given that the track that it's on right now under the status quo, can we manage that pay-go distance? You know, you're going to go pay, that's what the state's saying, what we all know is that you're going to go pay-go in 2041 if nothing changes. Can we manage around that a little bit? Can we manage around that plus or minus 5 years under a couple of scenarios, under a status quo scenario or under the state giving you an extra $5 billion a year scenario? So those are really the three, and we're wondering do those three encompass everything? Do they accurately represent your considerations? Should we finesse the wording to make it more appropriate? And when we get that information from you, we will quantify that, and then we go back and analyze every single possible portfolio under the sun and rank them based on their abilities to achieve these three, if not more, concerns. So that's sort of where we're at today. We want to just sort of nail this down so that we can begin to judge portfolios based on these issues.
Yeah.
I was gonna summarize.
The key here is this is going to be a compromise. And it's important to recognize that it is a compromise, that there is a trade-off between risk on the downside and opportunity on the upside,
Right.
and that's a judgment call.
Right.
Reasonable people can look at the same facts and reach very different conclusions. This exercise is a forum for you to negotiate and discuss where you come out. There is no right answer, and just like the interest rate assumption or the expected return assumption, in 3 or 4 years, you're going to revisit this. But right now, you have a set of facts and circumstances that needs to be addressed. The portfolio has certain characteristics. Do you want it to continue to have those characteristics for the next 3 to 4 years? And that's what the purpose of this exercise is.
And to continue on that, if you go to INV 180, let's just assume that those were the right three. Then what we're trying to do here is say what your risk tolerance is. That's a technical term that we use, but that's an incredibly important facet of picking a portfolio. And so the outcome is, assuming we have the right, what we call decision factors, or those key three issues nailed right, the question is how much are you going to emphasize them? And that's displayed horizontally on INV 181. You're going to decide how to emphasize those. We're not driving that. We're going to show you the trade-offs in the portfolios and how they perform based on those emphases. But we just sort of teed up some examples here. If you're really concerned about funding improvement over the long term, you might think about weighting that particular one 100% and just ride out the ups and downs associated with that one. But if you're really concerned about sustaining the system, you don't want to draw down. So you might put 100% of your chips on that second one. Or, as Alan mentioned, maybe it's a compromise. So look at the other two or three examples to the far right there. Maybe you're compromising between those and weighting those, evenly or a little tilting one way or the other. That, when Alan says that's the exercise, is that number one, getting those 3 or 4 items correct, and then number 2, weighting them accordingly through a process that we'll be teeing up in the next couple of sessions.
And then getting you the results. So if you want it with these weights, here's the result. So let's just hypothetically say you go to the most conservative risk-controlled portfolio. Well, the result of that will probably be a portfolio that has an expected return of 2 or 3%. And that's low risk, depending on how you define risk. And that's the conversation you as policymakers need to be involved in. How do you look at risk, and how do you combine the trade-offs between risk and return? Recognizing that it's going back to the comment between arithmetic and geometric returns. When you lose 20%, you need to make up 25% to make up for the 20 that you lost, because that's how the numbers work. And so you are not equally happy with the upside and the downside. The downside has a bigger penalty.
So can I just summarize, and then I'm happy to entertain questions from the board. Chris, so for the two that you suggested from the staff were pursue better funding ratio and keep the arc steady. Is that accurate? I just want to make sure, since we don't have the materials from CalSTRS.
So
There's 4.
Yeah, 2 return and 2 protect.
I agreed with the 2 protection-oriented ones at PCA. The only change I would make to the return-oriented one is, since we know the funded status will more than likely decline, what we were saying is strike the word consistently. So it would be like seek improvement, or seek improving the funded status over the next 30 years, rather than just consistent. We don't want the public to think we can climb from where we are straight up. And simply from a human nature standpoint, my concern is if you have 3 things to weight and 2 of them are red and 1's green, you're going to naturally lean toward the risk-oriented ones. I was seeking to give you 4 so that you had 2 green and 2 red, so that you would have a balanced choice. In the past two studies, you have had a phrase that was roughly seek the lowest average cost to the plan. I know there was a lot of debate about, you can't control contribution rates, but it is the idea that you want to seek to have some stability, and you want to seek to keep, you want to seek returns over the long term. So you guys have the control.
So did you sort of blend?
I blended the ones
Blended it
you've
with
used in the
PCA?
past 2 years. So I just said pursue better funding ratio over the long term. You could certainly say what PCA is using there, which is maintain or improve the funding status. The second bullet point we can certainly work on, but it was seek to keep the actuarial cost steady or seek to keep the cost of the system low. It is a return focused. I'll be honest, it got the lowest votes 3 years ago, and I think it was the second lowest votes 6 years ago. So it's up to you. If you're comfortable voting on just having a choice of 3 in the menu or whether you would want 4. But we're agreeing with PCA on these 3 with just some wording changes.
Just a couple quick comments. Bob McCrory from Chiron. You were saying you don't fight the Fed. Well, you don't bite the hands that feeds you. And since I'm a subcontractor of PCA, I have to agree with Chris.
Oh,
One of the big points of this exercise is to make this fairly abstract concept of investment risk concrete and real. So you see it in the terms that you have to deal with things in terms of funding and cost and those kinds of issues. For aesthetic and pedagogical reasons, I tend to like the idea of having 2 accelerators, 2 return-oriented decision factors, and 2 brakes. The drawdowns and the pay-go issue, just because it seems to give people an opportunity to split their preferences in a kind of more balanced way. There's lots of mistakes that you can make with these decision factors. One is to have too many. When you get up to about 6, what happens is the groups tend to just spread their votes uniformly across all of them, just because. So 4 is a good number. I also I think it's a good idea for everyone to see the consequences of underfunding and also the portfolio choice in terms of cost. So by and large, just aesthetically and for reasons of presentation, I guess I tend to favor adding another one. Whether it's exactly keeping the actuary cost steady or not, I think is something we want to play with. The process, and I won't take much longer, is that when we get this initial version of the decision factors from you, we'll take back and we'll simulate the dickens out of them. And then we'll see sort of which ones discriminate well among portfolios. And then we'll work with staff to make modifications as we need to. So you have 4 factors that when you change votes, it really matters.
Could you just translate that second bullet, what do you think it means to you? The second bullet up there?
I'm a little bit worried about, I like the idea of keeping the actuarial cost steady. Now, typically,
So
that would
translate it
be
for the board. What is the board saying there?
See, that I would look at level there, and if it were an accelerator.
and I would
And
encourage you, please change the wording. I was just looking for trying to match all the views I had heard.
And what I was thinking is to keep it at a reasonable level. Now, when you use the word steady, that almost sounds like a standard deviation type number. Mm-hmm. And if you want to keep the actuarial cost from varying from year to year, that becomes a break because it's going to favor the more protection-oriented portfolios.
So what would you say the right language there is to express, if you're trying to have the tactical balance you mentioned, what would be the right way of saying that for you?
I would try to, well, first of all, there's the question of whether you're not going to get any funding. If you're not going to get funding, it's kind of a dead issue because you can't keep the costs steady.
Well, the board doesn't control the ARC payment.
Yeah, that's right. So
I think some of the board members, we're just having some of it's just, some of it's the middle of the day, we haven't had lunch yet. Some of it's just some of these concepts. I think, up here, at the end of the day, we're trying to make decisions on how to be good fiduciaries of this fund. And I think, could you help us translate number 2 into what it really looks like,
At this
into
point,
the.
I'm not sure I can, because I'm not
Okay.
sure myself.
Okay.
So.
Maybe somebody else has ideas, but,
We didn't do that.
right,
Maybe
no. Everyone's washing their hands of it now.
Chris?
Chris,
I did.
since you did.
Yeah, no, I did. I'm on through the
What does
monkey
it
wrench
mean
in
to us
the
as
well here.
trustees, right?
It is a phrase you have used, that we used in the prior 2 studies, and that's why I said I am not wedded to the wording at all. But one of your mandates in the state constitution and in the education code is to keep the cost low for the employer. Obviously, I recognize we have lots of discussions about what the employer means. But so for that reason, I think you need something in there about keeping the cost of the plan low. I'm not wedded to the word steady. In the past, you had very specific language about keeping actuarial costs low between year 30 and 33, or keeping the employer cost from spiking during the time period. But the idea is to avoid is to seek return so that you're keeping the impact to the employers lower over time.
Can you give examples, though, Chris, of like what does it look like for us to keep the costs low of our? I just need some concrete examples.
Yeah. If you remember, Milliman yesterday talked about how we have being a mature plan and that we have a high asset factor. If you remember in one of the back of their reports, they talked about our asset factor conversion number, which is very high. We're highly sensitive to negative periods. But if you have positive periods compounding, then your funding status improves steadily over time. And so this would seek portfolios that would generate higher rates of return and help you improve that over time. It would, and that's why it would allow a portfolio with volatility in it. But the idea here is something that is return-oriented. And I recognize you're right in the middle of those discussions. So I defer to Ed and others of how do you define that? But how do you, with your constitutional goal to keep cost low, I wanted something in there as a decision factor you could include in it rather than leave it out.
Well, yeah, I think based on what he was saying, it sounds like he's suggesting that the objective would be to seek to minimize the total plan costs or the total normal and amortization costs, which is the same thing as maximizing the return. So it is return oriented. You do end up with, it's not risk based, it's return based. But that's ultimately what that objective would be doing, is trying to minimize those costs.
And maybe this is, but what I struggle with that is I think we've been talking a lot about risk in our conversations, and so I'm all for getting good return, but I also think we've been spending a lot of time talking about risk, and if we hedge with risk, then my assumption is our return is going to be lower. So I'm just trying to interface those concepts.
The whole purpose of the exercise is you vote, and then you see what the result of various combinations of risk and return
Got it.
is on various single components. So what does it do to funding levels? What does it do to cost, et cetera? With things that you do control, you don't control cost.
Right.
The key is to recognize you will have to make these trade-offs.
Right.
And so if everyone voted all for the one green, we get the highest rate of return, in an unconstrained world, you'd be 100% in private equity. Now, we know that's not going to happen, but the more you're concerned about the red ones, the less volatility there'll be in the portfolio, the lower the return, which we'll try to offset by adding diversification, which is very important. But there are no free lunches. And so if you dramatically try to improve the financial condition of the plan through the investment portfolio, you're opening yourself up to significant losses, which you might not be willing to incur. But that's a conversation for policymakers, not for consultants.
And Sharon, I would add, do not have a problem you approving the PCA. I want to be clear, I'm not opposing those. You had asked staff and the consultants to have differing points of view more and more often, and so I use this as an opportunity to have a slightly different point of view. And I think, as has been discussed, as long as you're cognizant that if you only have three options, that two are negative, only one's positive, and you're aware of that, I think that's critical. Like we said, from a voting standpoint, it's better to have a nice balance, but
Just dovetailing on a couple different points. If I'm putting things together in terms of the panel that we just had, as well as our discussions from yesterday, as well as our investment return assumption. So we're basically saying, look, we have an investment return assumption of 7.5%. In order to be able to get there, the only thing that we're looking to that gets above that level, after we take into account inflation, is private equity. And then we are, I struggle with the language here in terms of the improvement in the funded status over the next 30 years for the reason, Chris, that you stated in terms of even assuming contribution increases, we're going to be going down. So that seems like it would be something that would be chasing something that we know is unattainable. And thinking about the cost question, I mean, in some ways, the employer cost question works in both directions, right? If we are trying to achieve returns that we know are not attainable, then the effect is we're going to make our costs higher because we're going to go to places that we're not going to be able to get those returns. And in effect, we're, in trying to make costs lower, we in fact make costs higher. A bit all over the place, and I'm not sure that it helps in landing somewhere. But one, it tells me that I think talking about, consistent improvement in the funded status is not the right indicator, and the cost one I could hear as a brake and as an accelerator in terms of how it could work depending on what my assumptions of risk are, and it's just thinking about where this leads us to in June. It seems that these indicators and the presentation, the what we just adopted in terms of our expectations. Seem to go in the direction of saying increase our investment in private equity. And as we think about what other folks are doing in terms of sitting on cash, where we are relative to the economic recovery and how comfortable we are about whether or not it's taken hold and where it has taken hold and what the future holds, just struggling on where to land at the moment.
Yeah, Alan.
I couldn't agree with you more on your comment regarding the objective of seek consistent improvement, because I think everyone's thinking about it in an absolute sense, and I think it's improving relative to what had been had there not been a change. So if you make that relative as opposed to absolute, I think it's a very reasonable objective. But absent making it relative, I think you're right. That's unattainable.
So can you, Alan, just provide us a
Sure, seek consistent, I get rid of the word consistent.
Yep.
Is seek relative improvement, and just instead of the word consistent, use the word relative, and that would have been relative to what you would have done had nothing else occurred. And that gives you a baseline against which to measure. I thought that was rather elegant, but.
Well, and
pretty
Sharon,
fast after Anna's comments, really. So.
Sharon, keying off of Mr. Derman's comments about the second green one, we could and that it's somewhat analogous. If you think about it in a certain way, it's somewhat analogous, and we're wanting to have an equal balance of gas pedals versus brakes. That's somewhat analogous to seeking to maximize the return of the portfolio. I mean, you don't have to put weight on it, but that's what it's analogous to. So you could change it. You could change it to a return-oriented bullet instead of a cost-oriented bullet, and it sort of ends up pursuing the same function. Okay. If that helps with the intuition.
And I would say I like that idea. Seeking maximum rate of return is part of, as you look in the Constitution, part of your mandate. That's the words right out of there. And you would understand it's obviously at a prudent level of risk.
Okay, we have another question, Paul?
Yeah, kind of picking up from Anna's question, I think I too am, a couple of statements. And first of all, let me say one thing, which I think, I think we have to make a decision. We have to make an assumption about what the legislature will do, because I know from my own personal opinion, my investment strategy would be very different if the legislature were to take action to increase funding by $4.5 billion than if the legislature took no action whatsoever.
Right.
And so I think we have to, as a board, for the purposes of this exercise, make an assumption. And I think the only assumption we can make, because it's the world we deal with right now, is contributions where they are right now. And then if the legislature were to enact increases, then we would come back, and because the world would have changed, and our approach to risk and our upside and our downside would be different, so.
And we are gonna do that in 3 years, right?
Well,
Because
we
come back
could
to
do, but we could do it in a year
in
if
a
they
year,
took action.
right.
In other words, as soon as they take action, but right now, we know that even if we get 7.5% every year, we run out of money in 31 years, and we know that even if we, I mean, it'll happen faster than that because we'll have to be in a liquidation mode for the last, 5 or 10 years. But, so because I'm willing to take more risk if the funding is there. If the funding is not there, and we as a board don't have the ability to increase funding, then if things go wrong, we've got nothing to fall back on. And so we know that the funded status drops even if we get $4.5 billion increase immediately. We know that the funding status drops for the next 10 years and gets down to around 60%. And we know that anything less than that, and it goes even lower. And we know that if we don't get anything, it starts to go down even faster. So that's my first thing. But my other question,
Can I
yeah,
respond to that?
yeah.
Just to reflect back on you, taking that scenario, that of status quo, puts you in caretaker mode. That's the portfolio that you'll end up with.
Okay, so if the board doesn't make a decision to make an assumption,
Well, I think we need to say that. I mean,
If you don't get the
Paul, doesn't
support.
that plan on insolvency, that approach? I mean, should the board be thinking of asset allocation in terms of a anticipated
The
insolvency?
legislature doesn't do anything, we do run out of money in 2000.
If we assume there's no contribution change, we know what that projection takes us, right?
but we can't make decisions about. I guess maybe this is a question for Ian, but is our job then to just delay the inevitable as long as possible? And if so, maybe that's the approach we're supposed to take. In other words, we're supposed to minimize the likelihood of pay-go status in the context of no increase in contributions. But
We're not opposed to doing that. I just,
okay.
a one scenario world sends you on a certain direction versus if we want to look at maybe two scenarios.
All
but-
I'm saying, Jack, is that I know as one board member, I have a different approach to answering these questions if I know that there's going to be a solution forthcoming or a partial solution forthcoming relative to if there isn't. And because I don't see that there's a solution in existence right now, I think I would have to make a decision unless we as a board made a different assumption for this exercise. I would have to make the decision that I'm going to make that decision on the basis of no change in funding. But
Long-term. Well, I mean, it's a radical
yeah,
translation
and
of
then-
the,
but Jack, I'm saying then,
yeah.
as soon as the legislature takes action,
Right.
we come back and we
Based on this
redo
point
it.
in time.
But yeah,
Okay, but
I understand.
it's a big one.
yeah, it is a huge one. But
I think we just need
don't-
that translation in the conversation that if you're
But
gonna,
Well, and others don't have to agree with me
Right.
about that. I mean, I think that's the right way to do it, but others don't have to agree. But let me get to the second thing, which is, so I have a hard time, I know where I want to go. Okay, I know that I'm okay giving up some upside to avoid downside for a whole variety of reasons that have been raised. Given that, I don't know where I put my votes.
In an effort to try to help you go to lunch, which I've learned over 40 years of doing this, that if I fail in that one, I fail in everything. We're gonna suggest to you, we model it both ways. And you have that information, you can choose to use the information any way you choose, but that way you as policymakers can say, here's what happens with things as they exist today, and here's a what-if scenario. And that way, you don't have to make that decision today, which I don't think you'll be comfortable making.
Right. I think that's helpful because obviously we're starting the dialogue with the legislature this year around the funding issue. And I hear what you're saying, Paul, which is in this moment in time, this is what we know. And we need to base decisions on what we know right now. So I hear what you're saying. I think obviously there are some that are hopeful that there is going to be some movement and some
I'm
change.
hopeful
So,
too.
and I know you're hopeful.
We're all hopeful.
I know. And but your point is we shouldn't presume or make assumptions at this point. So I think this is why we pay the big bucks, right? For the I think that's a helpful solution. I've got a couple people in line still, so people can also comment on Alan's suggestion, but I think that would be a helpful way of us to move forward. So, Michael?
I'm not sure I understand any of the green lighted
The
proposals.
return-oriented ones?
Because it seems to me that, sure, everybody wants improvement in the funded status. Who wouldn't? Everybody wants reduced costs. Who wouldn't? And I'm not sure how that moves us forward. I like the break ones. I think that can help guide us. What I'm surprised at is that we don't, there's nothing here that talks about something that we've been discussing for some time now, which is the difference between the absolute return and the relative returns that we were dealing with. Because it seems to me that that's more instructive in terms of how we are going to allocate these assets. And if we say, listen, one of the factors we want you to look at is we want more absolute return, which will drive the way in which we compensate our investment managers and a whole number of different factors, all of which, if we do it right and it's done correctly, will result in hopefully higher returns. But it is not inconsistent with what Paul is saying and what these other two breaks are saying, avoiding significant asset drawdowns in the PAYGO status. So to me, it seems to me that the first one, and maybe the return-oriented one should be worded, seek assets to deliver absolute returns as opposed to a relative return type of environment. And the other things that are in the Constitution that are certain that kind of guide us overall, kind of drive us to that. So I would go to something along those lines and keep these other two, because I think that is a significant change to the way in which we have been allocating the assets over the last few years.
So, yeah.
We can make that a decision factor, and we have done that for clients in the past where we've had portfolios seek some form of a real return threshold. It might be a little bit. It might, in the spirit of absolute return, it might allow the portfolio to produce modest negative returns, but it does have an absolute.
We're never going to avoid negative return.
But it has an absolute return focus to it. Right. So we could make that a decision factor. That may very well be an appropriate substitute to my other option for that second bullet item. So it introduces an absolute return focus into the equation. But Bob had a response on why seeking funding improvement might be a good idea.
I think it's worthwhile in your considerations to know kind of how we actually score these things. we'll be searching a group of maybe, let's say, 10,000 to anywhere up to 30,000 different portfolios. And what we do is we go out and we measure these various factors for each portfolio, and we score based on those measurements. And so we might, for example, improvement in the funding status, we might look at, say, the average funding status over however many years, however we choose to do that, and rank all the portfolios, all 10,000 of them, and the ones that have the highest funding status score the highest, and the ones with the lowest funding status score the lowest. And that goes on in all of the decision factors. So that gives you some feeling maybe for kind of how the measurement takes place. In the case of return, it might be a compound return over a period of time, or a compound real return, or an average cost over a period of time. And that's what you'd measure. With cost, you'd get higher scores if your costs were lower, and lower if your costs were higher. The one area that's of some interest here is in the two scenarios, it might be that in the case of status quo, where we're getting no future funding, the cost we might measure is that increment of cost necessary to amortize the unfunded that Milliman presented yesterday. So that might be what we measure and use to score. If there is funding, true actuarial funding, then we would probably measure the total actuarial cost. That's the only difference. But I guess in whatever you do, as we discuss this, when you pass your motion, if you just make some allowance that we and staff can beat this back and forth a little bit based on our tests when we have the model running.
No, I accept that. So I think, based on what you're saying, we would keep some, improvement in funded status, absolute return focus, and the other two.
Right.
I mean, that's the way I see it. That's what I would like to see. And take out the focus on the actuarial cost, because I'm not sure I know what it means, and we have so little control over, even though it's in the Constitution, we have so little control over that. But the first two kind of drive that as a consequence if we do those right.
And that's exactly why we present it to you, to get input, to make these things reflect the previous discussion. So we like adding that one a lot.
I've got 3 people in line, so Rich, you're next.
So, Alan has offered me a way out of the rabbit hole that I've fallen into with this conversation, which is I need to see what it means. Because to be really honest with you, I don't quite get it. Right?
Yeah.
If we want to seek improvement in the funded status, there are 2 ways to do that. Right? One is we can make more money, and the other is somebody can give us more money. Right? I don't think there are, unless I've got this somehow wrong, there are no other ways to make that happen. Right? So you go back to the question that Paul raised, what does he think? Is somebody going to give us more money? And I think the answer to that is, my guess, unlike you, it's just not the status quo, is we'll get some more, but not nearly as much as we'd like, and not nearly as soon as we'd like it. But eventually, something's going to give. And so something will come in. So we can take that little piece of it. So the only other piece that's left is, do we want to somehow try to make a whole lot more money? Which means assuming additional risk. And for the red pieces, the asset drawdown is, we don't want to put anything at risk because we want to hang on to what we've got. We can't have one without the other, probably, unless somebody's got a new place for me to go that I haven't ascertained in the last couple of years here. But if we don't get someone to give us more money, we're going to be playing this kind of defensive game. And unfortunately, if we don't take the risk and try to get more return, we lose the game sooner, right? Because the money keeps going out the door at a fairly consistent rate. And if we're just hanging on to assets and not trying to make more money, that just brings us to a crash sooner. So unless I've missed something in these conversations, right? I mean, the fundamental question is, do we want to take more risk or do we want to take less risk? And I don't know, is that what you're talking about when you say translate these into examples? Because I
At the end of the day, that's exactly what the numbers will show you.
Okay.
And you go through the exercise and you say, if we take more risk, here's the range of outcomes. And he puts it in terms that people can understand in dollars and cents.
Then bring me the numbers, because the language doesn't help me,
Right.
right?
I think
The
he's gonna
language
bring
here
in the
doesn't help
numbers,
me.
Rich, he's got it, 2 scenarios, right? Anna?
And maybe it's, I mean, just piggybacking on what both Rich and Michael have said, it seems like having the 2 scenarios will help us think about risk, and it seems like the two alternatives that that we were thinking about was, or that at least I was hearing some of us thinking about, is in the return, in the one talking about funding status, being clear that we're talking about relative improvement in the, relative improvement in terms of how we're doing, with everything else being held constant. And then it seemed that building on Chris's more general, just, seek higher returns, and being clear that we mean real returns on that point. As kind of the 4-factor formula was part of what I was hearing us coalesce. I don't know
Thank
if
you,
that's
Anna,
correct.
that's great.
Neil
All right.
is penciling out a recommendation that he and I would, I think, jointly recommend, PCA and staff would recommend you consider as a motion. You want, I can't read your writing. You want to read that?
And you will work in Paul?
So pretty much verbatim, the relative improvement in funded status. So seek relative improvement in funding status over the next 30 years. Probably something like, for the other return item, seek rolling 3-year absolute returns above, and will allow us to fill in the X percent, but above X percent, and maybe that's 0. So I mean, absolute return means nothing less than, right? So positive absolute return over a rolling 3-year period. Something along those lines. I think just pretty much verbatim the final 2.
We'd leave the red alone.
Yeah, I guess I thought we were moving, at Rich's request, away from wording, and we were just gonna see some scenarios. We were gonna see, okay, here's a high risk, high return scenario. Run it through your simulation model. We got, this percentage chance that we're gonna get this return, and there's a higher chance that we're gonna maybe do worse or better because it's a riskier portfolio. Here's what a less risky portfolio gets us. Because I still wouldn't know, and maybe I'm just dense here, I wouldn't know how to vote on these because they in my view I'm only willing to take I'm only willing to seek more return if I'm comfortable with the risk that it involves. And risk is both upside and downside, and there's nothing here that allows me to kind of look at all 3, which is expected return, upside, potential downside risk.
If you go back to INV 180, we'll show you these. Okay, so we'll put all the points on improved funded status. What does that do? And that's
We know you can't do that, but
no, we can. We'll put
He's just saying it's not practical.
50% returns?
but we'll show you what that portfolio looks like. We'll also put all the points on
No.
total pay-go avoidance. That's taking no risk, getting rid of the pay-go risk. That's to the best of our abilities. What does that portfolio look like? And those will be very different looking portfolios. One will be very low risk. One will be very high risk. So we'll show you those.
One of the things the new board members don't know, sorry to interrupt you, Neil. Okay. You have multiple votes. The nice part about this is it's interactive. So we would say, let's say we have these 4 up here, you guys weight them. And we've had board members who did that, who said, I'm going to put all 10 points on that one this time. Let's see what happens. And you get to see the portfolios. And you get to see how did my other board members vote. And I would tell you at some funds where they've done this, the employer reps all vote one way and the employer reps all vote another. Then they do it again. And so we can do it 4 or 5 times as much time as you want to spend in June on it. It's very efficient with their system, and you will see the portfolios before you. So that way you get the numbers and it means something to you, so you can go back and forth between portfolio extremes and say, okay, like Neil's saying, what if I constrain for this? What if I give that more weight?
And I think, Paul, what we're doing there when I respond to you that way is this notion of what the word risk means. And risk is not just a high vol portfolio, but it really relates to, here's a couple of definitions of risk. You go pay-go, within 10 years or something along those lines. That's the risk to you. Or the risk is you get blown out, within the next 10 years with a negative 25%er. That's, avoiding that. You do that, you're going to have a very low risk portfolio. So we'll show you along those risk lines what the portfolios are. And they're very low risk portfolios within the constraints that we decide upon. Or unconstrained, I guess, however they want to look at it.